Hello traders, Gary Wagner here just after 1 o'clock in Honolulu, 6 o'clock in New York. It is Thursday, February 27th, 2020, and this is the daily report for gold and silver. Although there is still a day left in trading, this will be marked as one of the most critically defined down weeks in U.S. equities history. Just today alone, the Dow declined over 1,100 points. We're talking about a point drop this week in the Dow that results in about an 11% drawdown, 1% past the official definition of a correction, 3.2% of that today. We talked about the last few days that the Dow broke below the 200-day moving average, and that was followed today by a drop in the S&P below the 200-day moving average. That is certainly signaling that on a longer-term basis, this meltdown could stay with us for a little while longer. In the meanwhile, gold has not been acting in its superlative manner that it would typically do when you would see this kind of action in U.S. equities. Nonetheless, the opening letter lends some plausible partial explanations to that fact, but here's the key. Gold was up slightly today. We've had a series of higher highs, and we have held that one level we've talked about all week, which I believe is 3160. And under that assumption, we could easily see a bottom form over the next couple of days and a move back to higher pricing if the current sell-off in the equities markets continues tomorrow as well as into next week. Let's take a look at our price board and then to our technical studies. As we did yesterday, I do want to start by looking at the U.S. equities markets. They have been under such tremendous pressure this week. We've seen an 11% decline in the Dow Jones Industrial Average. That is an official correction. We haven't seen that in quite some time. We talked about that over the last couple of days. What we witnessed that was unique was a break below the 200-day moving average, and that's the first really solid break we have seen not only this year but in quite some time. Yesterday, we made note of the fact that it opened and closed below the 200-day moving average, and today our observation is that we got a gap down again. So we've had two full gaps this week in which we had dramatically lower opens than the previous close. That is definitely a signal of mass liquidation. Also, traders, take a look at the volume on this chart. It is enormous compared to what we have typically seen. We have seen it growing throughout the week. Now, another interesting facet when we talk about the U.S. equities markets has to be the Standard & Poor's 500, because traders, now we have that following suit. In other words, that was the one market that we were looking at between the S&P and the Dow that had been maintaining a price point above that 200-day moving average. And today we also had the NASDAQ follow in suit. It is trading dramatically lower. It is not below its 200-day moving average, but nonetheless, we've seen a gap down. We've seen one of the lowest pricing that we have seen throughout this year in the NASDAQ. Now to gold. It was lackluster for the better part of the day. However, as Australia opened, and that's what we're looking at now, we had a nice spike to the upside. It has traded now to a high of about 1651. It is backed off of that a little bit, 1648.20. Of course, this is right where we got out of our last trade, but there are a couple of reasons that I like it in here, and significantly it's a series of higher lows and the compression triangle or the compression of range, and we'll talk about that, of course, when we pull up our technical studies. Silver recouped up about 0.6%, 1785. Platinum went down today. Nominally, let's put it in the unchanged column, and then palladium continues to close at an all-time new record closing high, $2,781.60. We're looking for 3,000 and above. We'll see if that target can get hit. Let's take a look at our current technical studies, because we are on the cusp of issuing a buy signal, and I want to let you know what parameters we'll be looking at before we send out a trade alert. We're looking at our daily candlestick chart of the continuous contract of gold, of course, this representing the April futures contract. We can see an absolute range contraction if we just follow these lows. The same with these highs coming down. To actually have them touch, we really got to make that a tight angle. That we have kind of a mini compression triangle, but nonetheless, we have seen this market form that double bottom. We talked about that yesterday. That's simply called tweezer bottoms in terms of a candlestick pattern. It's not quite tower bottoms because there is no separation. Then we saw a higher low and then a higher low than the previous day. However, today was an inside trading day, so we did not get the higher high. But what we are getting is some pretty strong confirmation, as we talked about yesterday, that this area at about 1625 should hold. I didn't expect it to go below 1600 in that we had such a dramatic decline in U.S. equities, and we didn't really see them flock to gold as a safe haven. Of course, bonds is another story. Yields the lowest they've been in quite some time. The net drop in the dollar down about 0.6%. So in essence, what we're seeing is that the dollar itself, that dollar weakness, accounted for not only all of the upside pressure, but selling came into it to limit it to only $6.40. We'll have to see if we get a follow through tomorrow, but I will tell you this. If we can effectively see this market break above, call it 1648 to 1650, I'm fairly comfortable entering a trade from the long side. I believe that we could easily see a similar scenario that we saw last week when on Friday we had a decent close, but we had that high gap up on Monday. And traders, as we did yesterday, we're looking at Palladium closing at a new all-time record high. But today is going to be a little bit different because today I want to project where I think this rally could end. I'm using a simple formula. It is based upon Elliott wave and Fibonacci extensions. And simply what I'm going to do is take a look at the beginning of this rally at about $1,500 as it moves up to approximately $2,400. And when we calculate that move, we come out with about a $900 gain. The market then backtracks to roughly $2,200, which allows us to do a couple of quick off-the-cuff calculations, so to speak, in terms of where this market could go. Now, typically what you look for when you have your wave 3 is that it will go to about a 0.618% extension of that wave, but that only takes you roughly to this area about 2,800. However, the raw facts of Elliott wave is that wave 3 cannot be the shortest of any of the impulse waves, but it certainly can be equal. Because if we calculate an extension of about 0.78, that takes us up to about 2952. So it takes us a little bit higher up to this level right here. And if we do a 1-to-1, that takes us up to about 3150. And that's obviously where the automated get system is pulling its projection for the conclusion of a fifth wave. So traders, while there is a possibility that we're hitting some sort of short-term top, my guess is because the issue behind this move is a supply issue, we could continue to see it move higher as long as that predetermined condition exists and demand stays steady. So I would look for this market to touch upon $3,000 per ounce as actually a moderately conservative estimate. Traders, maintain your current neutral stance in gold. As I said, we have set our parameters to enter a trade from the long side. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.